Dave, I think the first question goes to you. Looking at the constituents and the shares that you discussed, there was no mention of Apple. Do you have any thoughts on that?
Yeah, look, we do have a position in Apple in our fund. It's a relatively small position, about 2%. I think, look, obviously Apple is a great company. Net, it's probably going to be affected by the COVID-19 pandemic. It's really about affordability of products. So they obviously have various schemes to try and help people buy new phones, pay off over extended periods. Their supply chain has responded very quickly. Most of their product is assembled in China, and that supply chain issues have been resolved. So they really are good to sell, but it's just a lot of their stores are still not open. They have opened them in China, but in the rest of the world, a lot of their stores haven't opened yet. So we would see a slight delay in their release. This is an important year for releases for them. Their new 5G phones, there might be a slight delay, maybe a month or so. So net probably hit a little bit by the COVID-19 pandemic. And they're relying on their services business to grow well ahead of their hardware business. And services at the moment is about 17% of sales. So I would say Apple is a good holding long term. For now, we don't really see much value in Apple.
Thanks, Dave. Pete, there were a few questions and comments from people around the tourism industry, both on the SAFT loan side, as well as questions around sort of any potential recovery or how hard we think the tourism industry might be hit. Do you have a view or two on that?
Yeah, I think tourism is in for a very tough place. I think you have to break tourism into two elements. One is domestic tourism. And I think ironically that might be all right if one looks further out. All the sectors, I think, are in for a very tough few months. I think government is very conscious of it. And I think the next few weeks are quite important from an inflection point of view, where there's going to be a lot more kind of gathering of people and seeing the results from an infection point of view. So domestic tourism, the hotel business, the restaurant business, I think a very tough year. I think people have just got to try and do everything that they can to cut costs. Having been through business cycles myself before, my personal advice would be to cut fast and cut quickly to ensure you've got enough time to survive. International tourism, and I think getting on aeroplanes, that can be delayed for a long, long time. I think international travel is probably going to take 2 to 3 years to get back to normal. Interestingly, I saw Carnival Cruises, one of the big 3 cruise companies in the world, announced yesterday that they're going to commence cruises again on the 1st of August. Which I'm a cruiser, I've been on a few in my life, and I'm certainly not going on a cruise anytime soon. So it'll be very interesting to see how people react. A lot of people saying the only people on the cruise ship will be reporters wanting to see how people react to it. So tourism is a very tough sector. I think often it isn't backed up by hard assets, so it's harder to get finance on it. But it's, I think from an equity market exposure point of view, we're not taking exposure to that sector at the moment.
Another one which we typically don't have a huge amount of exposure to is gold. There are a couple of questions coming through for that. Does anybody want to tackle that one?
Yeah, so I think, let me have a go first of all. I think you've got to view gold in the context of a portfolio. So at times like this, when the future is uncertain, diversification is always a good thing to do. And gold gives you quite a bit of diversification because it can react in the opposite direction to equity markets or in the opposite direction to all risk assets. So there's merit to having gold in a portfolio at a time like this. I think in terms of our investment philosophy, we're not typically, gold businesses are not great businesses over time, so we're unlikely to have big weightings in it. The downside, of course, is if the world does react and return to normalcy in a reasonable time period, people will start moving away from, the kind of protection type assets. And then as Nolan pointed out, if you convert in Rand terms, if you're a Rand investor in gold, if the Rand does come back as we expect, you can have a big reversion in Rand terms, in terms of your value. So we're not fighting against it from a diversification point of view. It probably makes sense. But you can't just assume in Rand terms that it's going to give you a return from here forward. It has given you a great return. The gold's trading now at 1 million Rand per kilogram. And that was 550,000 Rand if you go back into stages last year. I don't know if you want to add to that, Nolan or David.
I think you got it, Pete.
Nolan, while you're there, there's a question that's come through around dealing with government debt. Do we see any signs that the South African government is trying to inflate its way out of such?
Look, it's a long answer, but I'm going to give you the abridged version here. We did a presentation last year where we openly said that we think the South African economy works best when inflation's around 5%. Inflation is dropping to 2% probably in a month or two's time. Actually, that's quite a big miss. And that does have ramifications across the board. Companies are locked into wage agreements at maybe 4 or 5%. They're now doing CPI plus 2 or 3, which was inadvertent. So there are a lot of spillover effects. I think more inflation would actually be good. The problem with trying to inflate your way out of this for government to try and create inflation to push us back to the 5% is twofold. Firstly, it's a very, very difficult thing to do. It's kind of like pulling the pin on a hand grenade, putting it down and hoping you can control the explosion, because the government and central banks are very bad at controlling inflation. So it's a massively risky thing to do. The other point I'd make is that, the Federal Reserve in the States has done this quantitative easing, which basically means printing money. However, the Fed is one of the most trusted central banks in the world. The element of confidence in the South African Reserve Bank is high, but we're not the Fed. And, we don't have the world's reserve currency. So it would be incredibly dangerous. I actually take heart at the moment, and there's been a lot of sort of popular press, RET debate of should we just print money and get done with it. I take heart from the fact that our government has not gone down that route. If anything, they've actually, we are unlikely to inflate our way out of the debt. Unfortunately, that means we won't have enough inflation for a while, so we're going to suffer the opposite end of the problem. But once the economy comes back online, we think that will normalize as well.
Thanks, Nolan. I think if we can just switch back to some global stocks. Dave, you mentioned Warren Buffett very briefly. What are our views on Berkshire Hathaway?
I actually don't have a particular view on Berkshire Hathaway, and I don't think it's really appearing in many of our portfolios. I don't have, look, Apple is the investment portfolio was at about 200 billion. Apple is about a quarter of that. They've got big financial exposure, which we think is relatively reasonable value. But then you've got all their energy assets and their other insurance assets. It's typically been a good port in a storm. The businesses are extremely well run and very cash flow generative. But I don't think it's appearing in many of our portfolios. And to be honest, I don't have a particular view there.
Matt, if I can maybe just comment, I find it very interesting on the Berkshire Hathaway annual general meeting, which is kind of a bit of a cult event for people around the world. And for the first time ever, they opened it to the public online on Saturday night. So I stayed up late on Saturday night listening to Buffett and Munger and Charlie Munger. And I think David summarized it. It's basically an industrial conglomerate with quite a bit of financial and particularly insurance exposure, and gives you general exposure to the SA economy. I think the key difference is they're sitting with about $140 billion cash. So if the US economy comes back and shares continue to do well, you're probably likely to underperform a little because you're sitting with quite a big cash component, which won't be earning anything. But the other interesting aspect for me is Buffett certainly I don't think he's got much of a risk appetite. They need to buy something worth $50 or $60 billion. And his answers to many of his questions I find quite interesting. It was all reverting back to 20, 30-year investment. And he had no idea where oil was going. He had no idea where gold was going. He had no idea where any asset classes were going. He wasn't prepared to give any views. He's not acting with much conviction at the moment. But his one key trend, which I think has been quite consistent over the years, is don't bet against America. American ingenuity, financial strength, and competence will see it through. So I think you should see Berkshire Hathaway as a high-quality sort of quasi-ETF. It's got businesses right across the US component, very US-centric, with quite a big cash component. But certainly there was no sign that they're looking to swoop in and take advantage of current markets.
Thanks, Pete. I think we've got time for just one more question. We did touch on property sort of very briefly. A few questions have come through asking about property in general for the next sort of 12 to 24 months, but particularly out of those sort of locally listed property companies with foreign exposure, what are our kind of views on them and our topics there?
Yeah, so the local property market is a very difficult one. It's come off significantly, much more than anybody would have dreamed of. To put it in context, Redefine was trading at close to 12 Rand. If you look back 6 to 12 months ago, it's now trading at 2 Rand. So one of the 2 or 3 big bellwethers. I actually listened to the Redefine results presentation yesterday. And I think the issue with property is you've got gearing. So, if your equity value comes down 20 or 30%, then your loan to value goes up significantly. In the South African market, I think the higher quality property companies will make it. I think they're in the hands of the banks. Redefine are still covering their interest payments by 4 times. So while interest rates, while their debt levels are uncomfortable, the issue really comes in the next year about liquidity. So if they have to repay portions of debt or bonds or ways that they've borrowed money out there, they have to find a way to replace that. And I think the banks will work with them to see through that equation. A safe play, and the one that we're kind of trading around, is Growthpoint. I think it went into the crisis with a high-quality portfolio and quite low levels of debt. We actually quite like Resilient. That also went in with quite low levels of debt. So we're avoiding anything which has got levels of debt which could make its sustainability a big issue. Times are very tough. These are businesses that, across the sector, there might not be dividends for the next 12, even 24 months. So it's changing from a kind of income investment to a capital appreciation investment. So the property sector's got fairly high risk levels, but I think for somebody wanting to take a geared approach to a recovery and the world changing to normal, the top 3 or 4 listed property companies are attractive valuations, but expect a rocky ride. And you've seen from day to day, share price movements of 10, 15% are not unusual. Like Redefine's 2 Rand, it could well be worth north of 4 or 5 Rand. So you've got potential of 100% rise, but it does come with risk.